If you work at a hospital or health system, there's a little-known 403(b) strategy that some healthcare employees may have available through their retirement plan. In my experience, many of them had no idea it existed. I'm Mike Worthington with Stonebridge Financial Group. Today I'm walking through the details of the after-tax 403(b) and how it can be an important piece to someone's retirement puzzle. I'll walk through what it is, who it may make sense for, and what you should be asking your HR department. And stick around till the 2-minute 50-second mark. I'll share the most often overlooked consideration when it comes to after-tax funds. Let's make this real with a hypothetical example. Meet Sandra. She's 58 years old, works as a director at a regional hospital, and earns around $200,000 a year. For these higher earning years, she's looking to maximize the amount of annual savings, preferably in tax-advantaged accounts. She has $1 million saved in her 403(b), and she's on track to receive a pension plus Social Security when she retires at 65. On paper, Sandra looks like she's in great shape. But here's a planning challenge she may not have fully considered yet. When Sandra retires, she's going to have income coming from multiple directions at once: her pension, Social Security, and eventually required minimum distributions. When you add those up, Sandra could find herself with more taxable income than she was expecting, potentially bumping her into a higher tax bracket. Not a crisis, but it is something worth planning around while she still has time to do so. Here's where the after-tax 403(b) strategy comes in. Many 403(b) plans allow participants to make after-tax contributions on top of their standard pre-tax or Roth deferrals. Let me explain. In 2026, the IRS set a combined contribution limit, including employer contributions, at $72,000. If Sandra's employer contributes $15,000 on her behalf, and she contributes the standard $24,500 pre-tax, she may still have room to put in additional after-tax dollars on top of that. Now here's the part that makes this strategy worth paying attention to. Some plans allow what's called an in-plan Roth conversion, or an in-service distribution. That means those after-tax contributions can potentially be moved into a Roth IRA or a Roth account where the money can grow tax-free going forward. For Sandra, building up a Roth bucket in her final working years could give her more flexibility in retirement. She could draw from the Roth strategically to help manage her taxable income, potentially staying in a lower bracket and possibly reducing exposure to Medicare premium surcharges. Now, I want to pause here, because there's something many participants don't realize and can have major tax consequences over time, depending on the person's circumstances. Some employees do make after-tax contributions to their 403(b), but they never take the next step of converting those dollars to Roth. They just leave them sitting in the after-tax bucket. And on the surface, that might not seem like a big deal. After all, you already paid tax on the money going in, so how bad can it be? Here's the problem. The contributions themselves won't be taxed again, but all of the growth on those after-tax dollars, that growth is taxable as ordinary income when you take it out. So you end up with a bucket that's partly tax-free and partly taxable, and over a long time horizon, that taxable growth can add up to a meaningful amount. Let me show you what this can look like with a hypothetical illustration. Imagine Sandra has $100,000 sitting in after-tax contributions inside her 403(b). She leaves it there, and it grows at a hypothetical 7% annual return over 15 years. That $100,000 could grow to roughly $276,000. Now, the original $100,000 is not taxable because she already paid tax on it. But the $176,000 in growth, at an assumed 25% tax rate, she could owe around $44,000 in taxes when she takes it out. That leaves her with roughly $232,000 after tax. Now let's look at what happens if Sandra converts those same after-tax dollars to Roth instead. The same $100,000, growing at the same hypothetical 7% for 15 years, still reaches $276,000. But because it's in a Roth, all of that growth comes out tax-free. She keeps the full $276,000. In this hypothetical, the difference between leaving after-tax dollars in place versus converting them to Roth is roughly $44,000, simply because of how the growth is taxed. And to be clear, this is a simplified illustration. Actual results will vary based on your tax situation, plan rules, investment performance, and a number of other factors. But the core concept is real, and it's worth understanding. Before you get too excited, here are a few things you need to know. First, not every 403b plan allows after-tax contributions or in-plan conversions. You have to review your specific plan documents or ask your HR or benefits team directly. Second, executing this strategy involves some administrative steps, and doing it incorrectly can create unintended tax consequences. This is not a do-it-yourself project. You'll want a financial advisor and a CPA working together on this. Third, this strategy needs to be evaluated in the context of your full financial picture. Your pension, your Social Security timing, your income, your goals, your estate plan. What may make sense for Sandra may not make sense for you, and vice versa. A commonly recommended approach is to start by finding out whether your plan even allows it, and then bringing that information to a qualified advisor who can help you model out what the impact might look like for your specific situation. If you're a hospital or healthcare employee, I'd encourage you to take one step this week, find out whether your 403b plan allows after-tax contributions. I'm familiar with a few hospital plans and happy to help see if I can share details on your employer. That one answer opens or closes the door to additional tax advantage savings. If you found this helpful, I publish practical financial planning content for healthcare professionals regularly, and there's a lot more on the way. Thanks for watching, and I'll see you in the next one.